let me first welcome all of you to this second panel, regional panel on supply chains in Asia. As you all know, trade in general, particularly inter-regional trades and investment, are a biggest driver for economy in most of the emerging markets, including also in our part of the world, in Asia. In fact, the latest number that I got, over 52% of the trades that happening in Asia Pacific, so not only just in Asia, are actually done among the neighboring economies. Now, along with the rise with this inter-regional trade, we have also seen an expansion of investment and expansion of regional production networks, or also known as supply chains. Now, there are two common trades. Every time I look at this inter-regional trade, whether it's in Latin America, but particularly in Asia, there are two common trades that are actually quite vivid. One is basically the role of U.S., the role of U.S. economy as the final market of these final products, of these export products. So that's one common trade. The other one is basically the rising importance of China. Now, there are two components of this. One, China as a major trading partner. It's quite interesting that China is actually a major trading partner not only for Asia, but also for Europe, and increasingly for Latin America as well. And another one is actually China as investor, not only as a trading partner, but as an investor driving production networks of these supply chains across the region. So I think it's only natural that the repercussion that we have seen from the trade dispute between the two largest global economies, which is the US and China, not only having an impact in terms of the size of the trade activity itself, both in terms of global and the region, but also for us in Asia is actually looking at the distributions of the impacts across the countries because due to these production networks. And this is a concern that I have seen also since last year. We had the same meetings in Bali in October last year. Again, same meetings that we have when we look at the IMF World Bank meeting in October 2018. Again, if you look at the WEO, the World Economic Outlook report, just came up last Tuesday, highlighting again this issue of trade dispute and production network as part of these revisions of the downward revision of global growth outlook. Now, we are here today, very fortunate to have a number of seasoned economists that will provide inputs and start the discussions on this topic. Now, let me just briefly introduce them. I have Andres next to me here. He's an economist at the Western Asset Management Company. And Andres has been in a number of other investment firms as well. And he studied as well as economist at the International Monetary Fund. Next to Andres, we have an old friend of mine, Kor Hoi. He's the chief economist of ASEAN +3 Macroeconomic Research Office based in Singapore. Hoi has held various positions, senior positions at the International Monetary Fund, at the Abu Dhabi Council for Economic Development, and also at the Monetary Authority of Singapore. Then I have my colleague Trinh Nguyen. He is a senior economist for emerging Asia at Natixis, and prior to that he was at the Hong Kong Shanghai Banking Corporation based in Hong Kong. Last but not least, colleague from Government Investment Company of Singapore, Prakash Kannan. He's the chief economist there. And again, Prakash also was an economist at the IMF prior to his GIC station. Now, I will start the panel by asking each of them a specific questions related to the topics that we discussed. And then, once this is done, I appreciate very much if you guys can start asking questions also on the issue, because again, we need to also learn from all of you what are the key concerns that you have on these issues. So let me start with Hoi. Hoi, can I start with you on this one? The World Trade Organization has revised the global growth outlook. And this is the fourth time that they did that since April 2018. So this time the forecast is about only 2%, less than 2% for 2019, and just slightly below 3% for 2020. It's actually lower than the global growth outlook, which is typically, this is a bad sign for growth in general. My question, just to start the ball rolling, How much do you think this, again, in your views, the issue of U.S.-China trade tension contributing to this revision in global growth outlook? Particularly, can you take a look also in your area, which is East and Southeast Asia? Have you seen evidence of export diversion? Basically, have you seen export from China to US are being replaced or substituted by export of other ASEAN countries to US? Can you start with that, please?
Hey, thank you, Reza. Yeah, certainly there's been export diversion. And the slowdown in the global trade, we all know a large part of that is because of the US-China trade conflict. And I think last year is still a good year, relatively, because there's a lot of front loading and all that. So I expect that this year is going to be worse, meaning 2019. And if there's no deal on the trade war, it's probably get worse next year. So let's hope there's a deal next year. Well, this year rather. Anyway, next year is coming up very soon. But even if there's a deal, we all know that this restructuring of the value chain, the regional supply chain, is going to continue. It started even before the US-China trade conflict, because China has become a middle-income country. Wages have grown, have increased a lot, and you can already see that the producers are moving supply production to the CLMV countries in particular, especially the low-end labor-intensive industries, Vietnam, Cambodia, Laos, and Myanmar. They benefited actually enormously from this relocation of this supply chain. But if you look at recent export number for Cambodia, I think it's very striking because the export to the US in garment actually went up by almost 40%, right? So I think that's a large part of that is because of the shifting of the substitution effect, I guess that's what we call it, of supply from China, the production from China to Cambodia. And I think recently the export number for Vietnam also shows that there's been a surge in export to the US, although overall export may be much weaker. So that's, I think, the beginning of this relocation of supply and production away from China towards the region. Now, how fast that's going to take place will very much depend on whether there's a deal or not. This is not new, as we know, because if you look back in history, there have been a few major episodes of relocation of supply chain, reconfiguration of supply chain during the, I think, the Plaza Accord. I think somebody is going to address the issue. And also when China became a member of the WTO, when there's a massive supply of cheap labor, and China became the center of the processing trade, and most of the countries in the region produce intermediate inputs that feed into the supply. So this is an ongoing process driven by technology and driven by changes in cost and supply shocks as well as demand. Let me stop here.
Okay, thank you, Hoi. Trinh, I'm going to continue with what Hoi just said. There seems to be, going forward, you may find this structural change in terms of production-based reallocations. But in the short run, we see a pickup in textile of Vietnam. We see a pickup in Cambodia. We see a pickup also in Bangladesh, for instance. Now, how much those pickup you think is just relabeling of the products, re-exporting of the products, and where does it take before we get into the restructuring or reallocations of production base in this supply chains, please?
Thank you. I have 5 minutes to answer this, so I'm going to break into 3 parts. So first part is, let me just tell you what has happened so far in trade. Second part is, how do we get here? And 3, the arbitrage opportunities and what it takes for these countries to move up. First, when we talk about tariffs, we cannot talk about without talking about investment. Trade and investment go together. When we talk about supply chain, we have to talk about investment. So what's going on in investment in Asia, emerging Asia, Southeast Asia, India, etc.? Down everywhere, right? We know that investment in China is down, but did you know that investment is even more down in current account deficit countries such as India, the Philippines, and Indonesia. Did you also know that import contraction is the sharpest in those current account deficit countries by double digits? It's in high single digits elsewhere. We know that China import is down minus 8.5%. The second thing is that we know for a fact that trade war does not benefit the region in the short term because the data tells us that exports are down, imports are down, the credit cycle is down, investment is down, right? So there's a liquidity tightening even places that don't even trade, like India, where export to China as a share of GDP is like 0. So the second part is how do we get here? And the third part is how do we arbitrage from this? If you look at global value chain, and we did a study on this, it peaked in 2008. So it's not, Trump didn't start this decline in globalization, and it peaked and it declined. Now what's interesting is that if you look at the decline, it's across the board everywhere else, but for China, the decline is mostly it's a reduction in inputs, foreign value added, which means what it needs to import from abroad, but it actually has increased its domestic value-added exports, which are then being put into other countries to use as export, which otherwise known as intermediates added to other countries. What does that mean? It has vertically integrated supply chain. Now you ask the question, okay, so maybe it's because supply chains are getting shorter, right? Not just deglobalization, but more shortening of supply chain. And so we look at whether or not regionalization is happening, whether or not regionalization is happening in the EU. The answer is no, it's declining within the EU. Is it happening in Asia? No, it's declining with more varied results. Like, for example, Taiwan is a bit better. But what's interesting is China is deintegrating with the region, with Asia, where it's declining is better than elsewhere. And more interestingly, within Asia, we have a decline of GVC, a decline of regional, but there's no further integration with China. So there's only 3 countries where there's a rise in integration with China. That's Singapore, Bangladesh, and Vietnam. And I'm going to touch about this point in the next part. What does that mean? It means that as China integrates its supply chain and people become more dependent on China, China depends less on the world. And there's a backlash. It's not just in the US, but increasingly the EU, if you read the papers by Germany, but also increasingly regionally. What we found is that there's rising integration within Southeast Asia, and that's one of the interesting results that we found. And what's interesting is that if you look at the arbitrage out of China, it's mostly textile or what we call labor-intensive manufacturing. China FDI inflow is peaked in 2007, and by 2018 is down roughly 20-something%. But if you look at textile manufacturing, that's down greater than 50%. Where has it gone? It went to Vietnam, went to Cambodia, and went to Bangladesh. What's interesting about the results is that these countries are integrated more with China because although the manufacturing centers have left, they continue to import inputs from China. So when you look at Vietnam, for example, as a country, its DVX, which is basically what it uses to then integrate itself in the supply chain, it's very low, and it relies on a lot of foreign inputs for its production. Is there something wrong with that? There's nothing wrong with that. Vietnam's liquidity is so flush. Its junk bond is yielding at 4% for 10-year local currency, 4-ish. Okay, maybe 5. I don't know, somewhere between 4 and 5. But what does that mean is that although in the short term it solves the problem of current account deficit, it has now a current account surplus, and it has tons of liquidity, it has a problem 10 years from now, 20 years from now, when wages rise, which is essentially what happened in China. What is going to happen? Firms will leave. If you only can offer to the world your cheap labor, when your labor rises, it will leave you. So you need to be able to have something else to offer to the world, which is what China offers at the moment, which is a supply chain, which is ability, it is market, et cetera, et cetera. And so I think when we think about these countries in Asia, of course we're benefiting from the trade war, and it is before the trade war that the supply chain has shifted. Korea shifted investment to Vietnam before the trade war, and so far Samsung is going to do a lot. I think I run out of my time, right?
You can come back to that again, but that's
I just realized
you're
it.
putting a lot of things here, and I'm kind of spaced
I
from my
just look
notes.
at the clock. I'm sorry. I'm just gonna stop. It's a sudden
We'll give you
abrupt
another one on this one. Thanks, Trin. Thank you very much for that. Andres, I want to come back to what Trin actually just mentioned as well. When all of these things, right? I mean, it has happened before to us. I mean, it has happened 30 years ago, right? When U.S. and Japan actually had that. Is there anything that we can learn from that? And how does it going to be different or similar to what happens 30 years ago for us?
So first of all, thanks for having me on the panel. I'm not sure we can learn. We will learn much. Let me put it this way. So there's two angles that I want to explore a little bit. One is sort of the trade angle, and the other angle is more the financial FX angle. And you'll see some of these things are eerily similar, what happened 30 years ago and what's happening right now. So on the trade side, go back in time, essentially between the late 70s and the mid 80s, Japanese car manufacturing is eating Detroit alive. Market share goes from 7% to 22%. Japanese imports as a share of total US imports goes from something like 12% to 23%. The bilateral trade balance goes from flat to minus $60 billion and has stayed roughly there ever since. So this is obviously, on the US side, 300,000 jobs are lost in the car manufacturing sector, so this is perceived as a threat. And the consequence is that the US convinces Japan to essentially establish voluntary export restraints. And so this is essentially 81 to 84, and then it was extended by 1 year to 85. Call this sort of maybe a passive or defensive strategy on the trade side. Now, the switch from Reagan 1 to Reagan 2 in 85 essentially promoted a much more aggressive approach by the US administration. You've heard a lot about Section 301 now in the last 18 months. Now, this rose to prominence back in the days. Section 301 of the US Trade Act was used very actively and very aggressively to bring people, in particular Japan, to the table. But also, in terms of the negotiating table, but also to really use it as a tool to open markets for US exports, both on the trade side, but then also financial markets to essentially open up financial markets, and we'll get to that in a second. So the point here is, ultimately what happened, the outcome was that Japan started producing cars in the US. And that, in some sense, again, is something that has a little bit of an echo these days in terms of policy intentions. Now, so remember that the dollar essentially appreciated in a straight line between 78 and February, I think, 1985 by around 50%. Now, funny enough, once that had happened, the peak had happened, the U.S. trade balance, actually current account, improved, but the bilateral car trade balance, if you want, US-Japan, stayed flat. So more than anything, that is why sort of these voluntary export restraints got discredited in the literature, and that's also why it's more perceived as a change of taste rather than just a question of who is importing what from where. Now, that's that much for the trade balance. So the similarity here is the use of these instruments in a much more aggressive fashion, and the fact that ultimately Japan started using FDI to build cars in the US. On the FX angle, just very briefly, I mentioned the strength of the dollar between 78 and then 85. Now, initially, this was a consequence of a tight monetary stance in the US. This was the Volcker Fed. And then increasingly in the early 80s, this is a consequence of expansionary fiscal policy under Reagan. So you have a classic textbook reaction of the exchange rate to tight monetary, loose fiscal. You get an appreciating exchange rate. Now, fact is that starting in roughly 83, the interest rate differential actually changed. And so while the dollar cumulatively appreciated by about 50% in real effective terms, you can only explain the first 35% or so with this policy mix. Last 15% you can't explain. And so the point here is that similarly to the trade negotiations, you also had the so-called yen-dollar negotiations, which were essentially the monetary counterpart, where the idea was to open up the financial sector in Japan, and essentially promote inflows into the financial sector and promote a stronger yen because of these financial inflows. And then essentially in early 85, everything cumulated with interventions. Interventions started even before the Plaza Accord in September 85. And that is when the dollar really turned, and then, it's, as you know, came crashing down. The same 50% reversed it within 2 years rather than 6 years on the way up. And so the parallel here is obviously that in 2014, 2015, we have seen the US dollar appreciate by about 20%. Again, in response to a relatively tight monetary policy. This is the Fed getting out of QE and starting to hike rates and building expectations of a monetary policy cycle. But the point is, the second leg is essentially missing. So while there's a lot of talk of strong dollar, if you look at it in real effective terms, it really has strengthened those 20% in 2014, 2015, but since then has really been bumping around. So I think that is where the parallel stops. And the argument is that what we're missing is essentially the expansionary fiscal policy, as funny as that may sound given US fiscal deficits. Maybe let's start there.
I need to come back to you more on that one as well. So, Prakash, just to complete the first loop of this, Andreas started with this just beyond the trade, is investment as well. Now, as a major investor, not only in the region, but definitely in the region, how do you guys see these things play out, and does it influence, how you invest, given the changes in terms of the trade, potentially the supply chains? Is there any particular sector that becoming a lot more, getting a lot more attention from the investor perspective? Are we looking at a shift from FDI to more of short-term flow at this point, given the uncertainties happening as well? Can you shed some light on that one, please?
Sure, thanks, Reza. It's always a challenge to be the last speaker to try and add value to what a lot of good points already made. Let me make a few points, and again, kind of a little bit from an investor's perspective. So the first one, I think, is very few companies make a supply chain relocation decision solely based on tariffs. I think the set of companies that do that are the ones which are either operating in a very low margin industry and intersected with those which are very easily moved around. And I think that goes to Trin's points and Hui's point, where it's light manufacturing, textiles, etc. And this has been a process that's been going on, for the last, I would say, 5 to 10 years. And that's going to Vietnam, Cambodia, Bangladesh, etc. But instead, I think there are two things which I think weigh a lot more on companies and investors' minds at the moment. So I think the first one is just the overall uncertainty of the whole thing. It's not that tariffs have gone from 0 to 10% and stayed there, but it's you don't know if it's going to be 20% tomorrow or 25% the next day, and so that uncertainty with actually where the eventual tariffs land, I think would be issue number one. Issue number two is that Section 301 was mentioned here, but actually it's not so much Section 301 that weighs on companies' minds or even investors' minds, but actually it's the ECRA, which is the Export Control Restriction Act. And that one, I think, has a much more important implications, because it has the potential not only to have kind of entity-specific restrictions, but as well as getting to the heart of the tech supply chain, and that, in a way, kind of intersects with issues of national security, etc., which makes companies even from having to incorporate kind kind of risk management considerations into their construction of supply chains, right? So it's not just about dollars and cents anymore, but it's about kind of access to technology, and so in a way, it's trying to maintain security of supply, if you will. So these two things, I think, are actually a much bigger issues, especially for investors as well, than just kind of tariffs going from 0 to 10. As investors, it's been a little bit challenging. Obviously, Vietnam is kind of the darling of ASEAN at the moment. Everyone talks much about it. They're already kind of facing some sort of capacity constraints, whether it's land costs going high, labor shortages, etc. Taiwan is actually another country that we think actually has a lot of potential. And once again, there it's the tech supply chain which has shot, and a lot of outward FDI from Taiwan actually has come back into Taiwan, and I think that entire tech supply chain to us runs the risk of eventual, just some sort of bifurcation, if you will, of kind of different tech ecosystems between maybe one centered on the US, one centered on China, which once again, it's not necessarily a bad thing, but it just makes it difficult, I think, for companies to really kind of figure out where the future is likely headed, and that just I think that has been bleeding much more into activity rather than tariffs per se. I mean, I'll stop there, and then I'm happy to take questions later.
Thank you again. Just want to remind you guys, if you have any questions, please. No, let me start again. Let me go second round on this one then. What we have seen so far seems to me, again, Train and Hui started with this, is a low-end basis that seems to be affected immediately, labor-intensive, right? Yet the dispute that we have between US and China is a lot more on the high-end part. And this is also the story that we have with US and Japan in 1980s, where it actually lasted almost like until early 1990s. Toshiba was involved on that. It's almost like what happens to Huawei was something that happening to Toshiba. So I don't get the link here. I mean, what we see in, like you said, this is more on investment basis, but what we've seen so far is actually a lot more relabeling of products, high labor intensive. So are we seeing just the beginning part of this as far as the impact of this for us? How do we, again, if you look at the when you mentioned Vietnam, even for countries like Malaysia and Thailand, those are basically still not a high end of this technology. You talk about semiconductor or electronics, it's not the high end of it. How do you see again? So how the second run of this? I mean, the first run have taken places. Like you say, it's a natural supply chains type of activity that have taken before this. But what is the second run of this? Can I start with?
Yeah, okay. I think the supply chain is basically to allow countries to specialize on the area of competitive advantage so that you have the lowest cost possible in the production of the final product, right? So obviously, if labor is cheap, I mean, it's a Herschel-Lee model. If labor is abundant in a particular country, then you pull in those industries, those production that are dependent on cheaper labor. And this happened, after the Plaza Accord when the yen went through the roof, and the Japanese MNCs decide that certain parts of the production of the car can be outsourced to countries like Bangkok, right? Thailand rather, where they can leverage on the lower cost there. Over time, of course, there's a cluster being formed, and local suppliers in Thailand emerge, and which have now become global players themselves in terms of production of parts. So through that process, you have what we call the flying geese model, where you have stages of industrialization across Asia. So I think what we are seeing today is, possibly another big shift out of China and into the region. And many countries are now positioning themselves to try to attract some of the investment into the country. So Malaysia has now announced incentives to do that. We know Indonesia is very keen to do that, and the same thing with Philippines. But on the issue of cost, it's not just cheap labor, okay? Because if you look at the Philippines, they thrive on BPO. And BPO is not a low-cost industry. It is low-cost relative to the US, of course. But if you look at the average cost of a call center person, it requires a college degree to be able to do that kind of work. And the average salary of a call center person is about 3 times the national average. So it is where you can produce a particular service or product most efficiently. And some of these could be technology related, like what Prakash just mentioned. It's just that in the initial stages, you have a lot of these low-cost industries that will move out, and it's benefiting a lot of these, less developed countries like Cambodia and Myanmar. Myanmar, as without the garment industry, I don't think we'll be able to sustain the kind of growth that it has been in the last few years, given the problem that it's been facing. So that process comes with investment, as Trinh mentioned. So investment, trade goes along together. And this is a process that's going to go on for some time. It's the regionalization of the supply chain. And this regionalization started, I think you mentioned that the global value chain basically stagnated and declined after 2010. And that's partly because of the global financial crisis, when external demand collapsed, and the whole region just rebalances the growth towards investment and domestic production, consumption. So you see that when you look at the value added by source, the part of the value add of GDP attributable to external demand has shrunk from about 49% to about 30% today. So the region has become a lot more self-sufficient. It's still 30% dependent on external demand, but much less than before. And that's a result of this global financial crisis. So this is a process that's going to continue into the future, because Asia is just the fastest growing region. There's a very rapidly rising middle class, which the demand is going to continue to increase, and the demand will increase for more sophisticated product. And the more sophisticated product, will be facilitated by the new technology, the 5G, the AI, the Internet of Things. So this whole process, I think, is a longer-term trend that's going to continue, regardless of the US-China trade war.
I have 6 minutes, and I want to put these same questions to 3 of you. Trinh, I'll start with you, but please, Prakash and Andreas, think about this as well. Like you said, Trinh, China actually has started this process, and I think Prakash also mentioned this. There's overcapacity in China, in any type, in investment, in labor, and so on. And the story that we had in 1980s with US and Japan seems to be like it's only pushing it faster in terms of that reallocations of investment away from Japan, in this case away from China. And that bring all this shift in the technological transfer as well, or the flying geese that Roy mentioned. So are we expecting the same process? Do you think it's going to be something like along that line, where now, because of this, we'll see a lot more of this transfer of technology from China this time around to the rest of us?
So first, I'm going to answer the first question and the second question together. So if you look at trade war, what people focus on is like, what is being tariff rate, this and that. But actually, zoom out a bit. Let's look at what China imports and what it exports. It exports 2.2 trillion, imports 2.1 trillion, so plus roughly 100 billion, give or take. 2.2 trillion that it exports is primarily 90% manufacturing, right? The US import of China is primarily manufacturing. This is where China has a comparative advantage. It has a lot of people. Makes sense. What does it import from the rest of the world? It imports some manufacturing that it needs for production, but a lot of raw materials like commodities, soft commodities, and hard commodities. We know that for a fact. Now, this is where, what does it import from the US, for example? It imports soft commodities like soybeans, pork, etc., and also oil, natural gas, but also tech, Boeing, airplanes, and semiconductor, these two areas. Now, what China essentially import is essentials for its production because it has vertically integrated its supply chain. And what really freaked the Trump administration and also basically the rest of the world is that it copies Germany's plan, industrialization plan actually, and made the Made in 2025, where it puts in semiconductor, a lot of these high-tech products. And it actually spooked also South Korea, many of the North Asian that specialize in this, right? China has a trade deficit with a lot of North Asian traders. Now, why is this important? Because the way China works is that it moves up in the value chain. If you read the White House position paper on this, is that it does so at a state-led level, right? In order to do so, it gives it capital, it deploys it, and so can you compete at a state level? It's done that with telecom, where it dominated, it's done that with panel, and now it's trying to move to semiconductor. So this is where that high-tech curve that we're talking about in terms of investment from the U.S. side, because it says, listen, if you're going to go at this at the state level, we are too, right? We're going to play this game. And the second question is regarding, I forgot what it was.
Well, my question is actually a lot more on the investment push itself. Are we going to be translating that to
So if you look
ASEAN?
at the rest of the region, it competes with China. So when we did this exercise a year ago, which actually became true, is that can the rest of Asia benefit from the trade war? Can we arbitrage? Right? Because we know that we can substitute. If there's a tariff on manufacturing, why don't you just buy somewhere that's cheaper? Why? Because China market share of manufacturing is 19%. And it's even larger in some sectors like machinery, etc. And what does that mean? Southeast Asia is the same. You know, some segment like Vietnam's at the lower end, textile and some assembling of electronics, but at higher end you got the Malaysia of the world, you got Thailand, and so Asia, for the most part, with the exception of Malaysia and Brunei, and to a lesser extent Indonesia, is more similar to China than it isn't, which means that Asia competes with China at every segment of the manufacturing chain. So at the lower end, you may have the Bangladesh and the Cambodia of the world competing with China at the lower end, but at the medium, you got Thailand, Malaysia, and at the high end, you got North Asia, right, which is basically what China wants to get to. And if it successfully vertically integrate this, which you can't, right, because there's some arbitrage at the bottom which goes out to Vietnam. And so this story is that, yes, the Southeast Asian countries can arbitrage from this, but only in the medium term, because Vietnam is too small. It's only about 90 million people, and our factories started moving there in 2011-ish. So how can you absorb from a country that's 1.4 billion people? How can Thailand absorb? It can absorb some, and it is, and so is Vietnam, and so is Malaysia. But Indonesia needs to do more, and particularly India. So if we want to talk about 40-something% of China's gross export, which is 2.2%, it's actually foreign invested. If you really want investors who invest in China only then to export, and if there's a barrier to this export via tariff, then you need to do more in addition to the push. You need to pull, right? So this is something that even Mexico is trying to do. So it's to be going beyond China to the rest of the emerging market, where there is an acceleration of competition to catch this diversification play.
40 seconds, guys. Andreas. Maybe let me take a slightly different angle, come back to what Prakash said. So just non-investment advice in 30 seconds. So we're a global fixed income house, so boring is good. So while a lot of stuff what's going on here in terms of supply chain reallocation are probably equity stories, we're actually quite nervous, or we would be quite nervous about some of the capacity constraints that we've been talking about, because ultimately that's going to show up probably in inflation one way or another. Other than that, we would also probably be concerned about sort of the global economy overall, sort of more downside to it, and sort of look at some of Asia as potential hedges to that. 30 seconds.
20 seconds for you? Nothing?
Great. No, I mean, look, I think China is too big a market to ignore, and there is a different supply chain that already feeds into China's domestic demand, and I think that is, if anything, increasing. And I would agree with what Trin was saying about actually getting more kind of vertical integration happening within China. And from an investment perspective, in addition to what Andreas has said, I think it's the similar analogy to the gold rush, where you want to supply the pickaxe and rather than really kind of investing in the gold mines. So here, I think is actually you are hitting capacity limits in a lot of these countries, and so that whole infrastructure drive, I think, is where that could be very good potential returns.
Thank you all. Thank you very much. Can we give a round of applause to all panelists? Thank you.